This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. It's been a volatile month, with sentiment changing almost daily. Investor concerns over excessive AI capex one day are then offset by strong earnings the next. And in the background, conflict in the Middle East continues to cloud the inflation outlook, pushing bond yields higher. So, have we reached a turning point for AI? That's something we'll discuss today. And to provide the insights is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Tracey, let's start with what's really caught my eye this earnings season. It feels as though every major technology company is announcing another massive increase in AI investment. This includes companies such as Microsoft, Alphabet, Meta, Amazon, and the numbers are becoming hard to comprehend. Just how big has this AI spending boom become?
Yeah, well, I think you're right to focus on AI spending. Certainly, that's what most investors have been focusing on this time around. I think, for the most part, investors are not really asking the question, how much did you earn this quarter? I mean, they're obviously concerned about that, but they're more focused on how much are you planning to spend next year? And as you mentioned in the intro, the numbers are really extraordinary. Collectively, Microsoft, Alphabet, Meta, and Amazon are expected to spend well over $400 billion on capital expenditure this year. That's a big number. To put it into perspective, that's larger than the annual economic output for countries like Denmark or Malaysia. These companies are literally reindustrializing our economies, and so these numbers are big.
What's interesting, Tracey, though, is that the spending doesn't seem to be slowing. If anything, every earnings season, the budgets seem to get bigger.
Yeah, that's exactly right. Let's look at Microsoft, because I think it delivered the standout result of the reporting season for tech, at least. Revenue increased ahead of expectations. Its cloud business grew ahead of expectations, and its cloud margins are holding up. The interesting point is its 365 Copilot growth. That was pretty interesting. Copilot has grown from 20 million paid users to more than 30 million paid users in just one quarter. So that's pretty amazing. 10 million additional users just in 3 months. And each customer is paying an average of $30 a month. So 30 million users at $30 a pop, that's 900 million of recurring revenue every month. And perhaps the number that impressed investors the most was its contracted cloud backlog. That increased from 627 billion to 678 billion in just 3 months. So this matters because one of the biggest fears around AI has been AI hyperscalers building infrastructure before customers even exist. Now, Microsoft's answer this week has been, well, no, our customers do exist. Our customers have already signed contracts. So that's tangible evidence that customers aren't just experimenting with AI anymore. This was the first earnings report where investors could point to hard, measurable evidence that AI spending is generating commercial returns rather than simply management optimism. They're signing long-term contracts. That demand is real. And so Microsoft shares rallied. They went up because the company was able to demonstrate exactly where the returns are coming from.
I see Microsoft seems to have convinced the market that the investment is paying off. But was that true for everyone?
Not quite. So Alphabet, it was another excellent result. Google Cloud, part of the Alphabet family, revenue there grew by more than 80%. That's one of the fastest growth rates among the hyperscalers. Again, AI demand was exceptionally strong. But unlike Microsoft, who was able to point to AI revenue, Alphabet was only able to point to AI demand. Now, those aren't quite the same thing. And also, Alphabet is spending more money than the operating business generated. So it's negative free cash flow. The market didn't like that. So that was Alphabet. And then we had Meta. which also produced a strong earnings report. Both Microsoft and Meta are both spending extraordinary amounts on AI. The difference here is that Microsoft, again, can point to clear, measurable revenue streams today. Meta is still asking investors to believe the payoff will come later. And the thing that shocked investors with Meta was how much their free cash flow dropped. It fell by 90%. Now, for years, investors viewed Meta as an incredibly cash-generative business. Now, almost all of that cash is being absorbed by AI investment. So all three companies reported very strong operating results. The difference was that Microsoft just gave investors the clearest evidence that its AI investment is already translating into hard numbers, into real revenue growth, customer adoption, and also, more importantly, a growing backlog of signed contracts.
Tracey, for Alphabet and Meta, investors are still asking, show me how this next wave of spending turns into future earnings.
Yeah, and the earnings confirmed that AI demand is incredibly strong. Cloud businesses are accelerating. Enterprise customers are signing larger contracts. Copilot adoption is growing rapidly. None of that suggests that demand is weakening. But what has changed now is the conversation. 2 years ago, the market celebrated every increase in capital expenditure. More spending meant more chips, more data centers, more growth. Well, today, investors are becoming much more disciplined. They're saying, we understand why you need to invest, but at this scale, we also want to understand the economics of that investment. So the debate has shifted from, whether AI is worth investing in to how much investment is enough.
That naturally raises the next question. If the hyperscalers are collectively spending more than US $400 billion this year, where is all that money actually coming from?
That's a very good question. And that's a question that is coming up more and more. It came up in the last few weeks, in fact. Because if we'd had this conversation some years ago, the answer would have been very, very simple. The hyperscalers were funding the AI boom themselves. Microsoft, Alphabet, Meta, Amazon, they're all incredibly profitable businesses, and they were generating enormous amounts of cash every quarter. So their AI investment was largely just being funded from their own cash flows. But now we're entering a new phase, I think. The scale of investment is becoming so large that internal cash generation is no longer keeping pace with the capital expenditure. And that's what the market is focusing on. Reuters published a really interesting analysis this week. It looked at analyst forecasts through to 2027 and found that the major hyperscalers are expected to invest around $1.60 US for every additional dollar of operating cash flow they generate. So that is, like Alphabet right now, they'll be spending more money than the operating business generates. And that's what the concern is for some investors. The AI investment cycle is no longer being funded entirely from these extraordinary internal cash generations. It's increasingly drawing on external pools of capital.
Tracey, where does that capital come from?
Well, we've seen this. We've seen these tech companies tap the bond market. Oracle is probably the best example there. It raised tens of billions of dollars to help fund its AI infrastructure expansion. And then, of course, you've got the equity market, and we've had two really good examples of that over the past couple of months. The first was SpaceX, which completed the largest IPO in history, raising around $86 billion. Now, SpaceX isn't an AI company, but that transaction is significant because it attracted an enormous amount of investor capital. So it suggests that these companies can access that capital. The second example was SK Hynix. That's the Korean memory chip maker. It completed a US listing, raising in what was one of the largest equity raisings ever by a foreign company in the United States. And there are more AI infrastructure companies looking to come to the equity market. So that's one source, the equity market and the bond market. Funding, too, is also coming from other tech companies. We've heard a lot recently about NVIDIA providing financing for OpenAI to build a data center and to buy its chips. And then other sources of capital coming from private markets. So private equity firms like Blackstone and Brookfield and Digital Bridge are raising billions of dollars to build data centers. I think a really important point here is that the tech companies now are not just competing for subscribers, they're competing for capital. And in that regard, they're not only competing with each other, they're competing for capital with governments who also have big spending plans. So there is an increase in competition for capital, which is why we and others believe we're in this higher for longer interest rate world because of this growing demand for this limited supply of capital.
Yes, AI has become one of the world's largest consumers of investment capital. The unfortunate thing is, this is happening at the same time as bond yields are hitting multi-decade highs.
Yeah, exactly. And I think I don't think we've fully appreciated how significant that is. Not only are the sums huge in terms of the capital required to build out, but now the cost of getting that capital for the build out is higher. For years, technology companies were incredibly capital light. The biggest companies generated so much cash. Remember, some podcasts ago, we used to say that Apple had cash on its balance sheet the size of the Hungarian economy, and that was after it bought back 40% of its shares. And now these tech companies, not Apple, but others, are building physical infrastructure on a scale we haven't seen before. So this is starting to look less like a tech industry and more like an industrial revolution. And industrial revolutions require capital, lots of it. So that means that that doesn't mean that the investment is wrong, of course. It's crucially important. In fact, Microsoft's earnings suggest quite the opposite. But Microsoft is also the exception so far, for the most part. The market rewarded Microsoft because it could clearly demonstrate where the returns were coming from. For everyone else, investors are asking tougher questions.
Tracey, whenever we see an investment boom of this magnitude, history tells us that eventually someone builds too much. So is AI heading down the same path?
I think that's a fair question. And history tells us that whenever capital floods into an industry, it usually ends up with too much capacity. The important thing for investors is not asking whether there'll be oversupply. It's asking where will that oversupply be? Because AI isn't just one industry. It's an entire ecosystem, and different parts of that ecosystem have very, very different economics.
Actually, let's work through the supply chain. Where do you think the risks are highest?
Well, I think the obvious point to start with is with memory. That's where I'd be most cautious. Companies like Samsung and SK Hynix and Micron have all announced enormous investment programs because demand for high bandwidth memory has just exploded. That demand is very real, but memory has always been one of the most cyclical parts of the semiconductor industry. Capacity can be added relatively quickly. And history tells us that memory producers have a habit of overbuilding. And with China knocking on the door now of that industry, that risk is very real. The market is starting to ask whether supply could eventually catch up to demand, and I think that is a fair question to ask. Although if you listen to Jensen Huang from NVIDIA, he doesn't believe that that supply will catch up to demand anytime soon.
Lucy, what about data centers? I mean, surely that's where everyone's worried about a bubble.
It's certainly where the spending is most visible, but I actually think the picture is more balanced. Yes, there's an enormous amount of data center capacity being built, but demand is also growing at an extraordinary pace. And more importantly, data centers aren't just constrained by capital. They're constrained by electricity, by transmission, planning approval, skilled labor, access to land. Those bottlenecks will naturally slow the pace of new supply. So while we'll probably see periods of local oversupply in some regions, globally, most analysts are suggesting we're less convinced that we're about to see a glut of data centers.
Finally, Tracey, what about the companies actually making the equipment?
Yes, so here we're talking about ASML. That's the Dutch maker of machines that make advanced chips. Now, it's effectively the only company in the world capable of manufacturing extreme ultraviolet or EUV lithography machines. These machines are essential for producing the world's most advanced chips. There simply isn't another supplier out there. And so that gives ASML enormous pricing power and an exceptionally strong competitive position. You could probably argue that ASML has the widest and most sustainable moat of any company in the AI supply chain. It's really complicated to build one of these machines, and it takes many 100,000 different components. So even if chip demand softened for a period, customers can't simply switch to another manufacturer. And I know there is news that China has developed a lithography machine, but it's said to be a very low-end machine. It's said to be equivalent to where ASML was perhaps 15 or 20 years ago. So the economics here are completely different from memory.
Not all parts of the AI supply chain should be treated the same, particularly when we're talking about capex.
And I think that's one of the biggest investment lessons from this cycle. The AI investment theme remains intact, but successful investing increasingly requires distinguishing companies monetizing AI from those merely spending money on it. 2 or 3 years ago, investors could almost buy anything with AI in the name. Today, that's no longer enough. You have to understand where each company sits in the value chain. Is it a commodity supplier like memory, whose product is easy to manufacture and where returns are or can be competed away over time? Or does it own a scarce asset with genuine pricing power? Does it sit in the part of the value chain where there are clear and sustained supply shortages, where the bottlenecks are? I don't think the AI investment story is ending. Far from it. The demand from enterprises, from governments, from consumers suggests this build-out still has years to run. But what is changing is that investors are becoming much more selective. The easy money has largely been made. And from here, success is likely to depend much more on understanding the economics of each part of that supply chain. Some businesses will face increasing competition as new capacity comes online. And I think here, watch what China does. Watch where China is focusing its attention. Someone said to me once, whenever China enters an industry, the profits exit. So watching what China does is pretty important. But others will remain constrained because their technology, the intellectual property or engineering capabilities simply can't be replicated overnight. And so I think in that respect, we should be thinking of this, that the AI trade is maturing. It's not ending.
Every major investment cycle creates both winners and losers. And the winners aren't always the companies spending the most money. Quite often, they're the businesses supplying the essential bottlenecks. That's where pricing power tends to be strongest. And that's probably the lesson to take away from this recent volatility. That's all we have time for today. Thanks, Tracey, again for those insights. Hope everyone enjoyed the update. And of course, we look forward to you joining us for the next podcast. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.